Picture this. You've worked hard, you've saved diligently, and you're staring at a very sizable nest egg in your traditional IRA or your 401k. And that's great. But here's a problem lurking in the future: taxes. What if I told you there's a way to take control of those taxes before they control you? That's the main benefit of a Roth conversion. Because for every dollar you have in a pre-tax account, like a traditional IRA or a 401k, you have a dollar that's an IOU to the federal government. And they're eventually going to require you to pay taxes on that amount that you've been deferring for all those years. But before you start panicking or moving money around, let's talk about the pros and the cons of Roth conversions and how to decide if it's the right strategy for you. Hi, my name is Kurt. I'm a certified financial planner. And on this channel, we explore money and meaning. So first, let's break it down. A Roth conversion is when you take money from a pre-tax retirement account, like a traditional IRA, 401k, you pay taxes on it now, and you move it over to a Roth IRA. The big benefit? Once the money is in a Roth, it grows tax-free. And when you take it out in retirement, you owe Uncle Sam nothing. Sounds great, right? Well, it can be, but only if it's done strategically. So let's start with the pros. First, you have tax-free growth and withdrawals. Once your money is in a Roth IRA, it grows tax-free forever. No required minimum distributions or RMDs, no taxes on withdrawals, and that's a big deal, especially if you expect to be in a higher tax bracket later or live a really long time. The second benefit is you could potentially have an RMD-free retirement. Traditional retirement accounts force most people to start withdrawing money at around age 73, whether you need it or not, which can sometimes push you into a higher tax bracket unnecessarily. Roth conversions help eliminate some of that risk. The third benefit is it's a hedge against future tax increases. Now, no one knows where tax rates are going to be in 10, 20, or 30 years, but most experts do expect tax rates to be higher at some point in the future. So a Roth conversion locks in today's tax rate, giving you a little bit more certainty in an uncertain world. And the fourth really big pro is it's a great estate planning benefit. So if you leave your money to beneficiaries in a Roth IRA, it's a fantastic vehicle because your beneficiaries will also get tax-free withdrawals, and it makes it a really powerful wealth transfer tool. But this is very different than a traditional IRA. Anyone that's not your spouse, if they inherit a traditional IRA, they must withdraw that full balance within 10 years, paying income tax on those withdrawals since the original contributions were pre-tax. Now, spouses have a little bit more flexibility, including being able to roll that into their own IRA, which delays RMDs or required minimum distributions, or they can use the 10-year rule. But this is especially inefficient if the beneficiaries are already in a high tax bracket and they're going to be forced to pay a lot more in taxes than they otherwise would be if they were inheriting a Roth account. Now, Roth conversions are not all sunshine and rainbows. There are some real downsides to consider too. So let's talk about a few of them. Number one is it's an immediate tax hit. When you convert, you pay taxes now. And if you're in a high tax bracket now, that can be especially painful. Another really important thing to consider is there are potential IRMA surcharges. So if you're on Medicare, a Roth conversion could increase your modified adjusted gross income, MAGI, pushing you into a higher income-related monthly adjustment amount, or IRMA bracket. So that means higher Medicaid premiums for at least a year. So you have to balance that surcharge in Medicare premiums with the potential long-term tax savings. The third con that I would tell you about is that breaking even does take some time. So if you've already been retired for a while, you might not have enough years left for the tax-free growth to outweigh the upfront tax cost. And since none of us really knows how long we have on this earth, it's a crucial consideration before doing a Roth conversion. The fourth con is, and this will be different for everyone, but there are state tax considerations. So not all states treat Roth conversions the same way. Some states don't tax retirement income at all, meaning paying taxes now might not make sense if you plan to move to a lower tax state later. And then the last con is you have to consider the 5-year rule. Each Roth conversion has its own 5-year clock before you can withdraw converted funds penalty-free. So if you need access to this money sooner than 5 years, you could be facing both taxes and penalties for those withdrawals. So it's important to consider these assets as untouchable for at least 5 years. So how do you know if a Roth conversion is right for you? It comes down to a few key factors. Number one, current versus future tax brackets. If you think you'll be in a higher tax bracket in retirement, a Roth conversion might not be a great idea. But if you expect to be in a lower tax bracket, it might be worth it. Another really important consideration is what's called the terminal tax rate. This is the rate at which you or your beneficiaries will ultimately withdraw the money. So if your tax rate is lower today than your expected terminal rate, a Roth conversion might make sense. And the third thing you have to figure out, and we'll talk about this in a second, but it's how much should I convert? So this is where things get tricky, because if you convert too much in 1 year, you bump yourself into a high tax bracket. And if you convert too little, then you don't really take full advantage of the tax-free growth. So a common strategy is to fill up a lower tax bracket each year without jumping into a higher one. So how do you find that sweet spot? Well, now that we understand a little bit about the pros and cons, let's talk about finding the right number to convert each year. Here's some things to consider. First of all, tax brackets and thresholds. Look at your current tax bracket and determine how much room you might have before bumping you into that next tax bracket. Second consideration, we already talked about it, but it's IRMAA Medicare surcharges. So if you're on Medicare, be mindful of the income limits that could potentially increase your premiums. Another main consideration is cash flow and tax payments. So can you afford to pay the conversion without dipping into retirement savings? Ideally, you could use cash from outside your retirement accounts to pay for the taxes. But it's important to do the analysis both ways, paying taxes from outside accounts or withholding taxes from the converted amounts. And then one of the last considerations is your time horizon. The longer your money stays in a Roth, the more time it has to grow tax-free, making the conversions more beneficial for younger retirees. So, should you do a Roth conversion? The answer, like most financial planning questions, is it depends. It depends on your tax situation, your retirement plans, your estate planning goals, and even your Medicare premiums. But one thing is certain, a Roth conversion done strategically can be one of the most powerful tools in your retirement tool chest. Soon, I'll do a case study where I really show the power of this strategy. So if you want to see that and continue to learn more about aligning your money and your meaning, please consider subscribing. Thanks for watching. We'll see you next time.